Question 1. The efficiency study reveals that the current underwriting process for air cargo policies, which are insured under an all-risks, institute cargo clauses (ICE) wording, does not explicitly address the inclusion of war and strike risks. While the institute war clauses cargo and institute strikes clauses cargo are attached to the policy, the underwriter is unsure if their application to air transit is automatically assumed or requires specific endorsement. Which approach best ensures compliance with regulatory expectations for clarity and accurate risk assessment in marine insurance? Option A. Interpret the all-risks coverage of ICCA as inherently excluding war and strike risks for air cargo unless specifically added, and therefore, advise the insured that these risks are not covered. Option B. Assume that the institute war clauses cargo and institute strikes clauses cargo automatically apply to air transit under the ICCA wording, as is common practice for ocean transit, and proceed without further action. Option C. Seek explicit confirmation from the insured and consider adding a specific endorsement to the policy, clearly stating the inclusion of war and strike risks for air cargo to remove any ambiguity. Option D. Apply the institute war clauses, cargo, and institute strikes clauses, cargo, to air cargo without further consideration, relying on the general broad application of these clauses. Correct answer is B. Assume that the institute war clauses cargo and institute strikes clauses cargo automatically apply to air transit under the ICCA wording, as is common practice for ocean transit, and proceed without further action. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how standard marine insurance clauses, particularly those designed for ocean carriage, interact with the specific risks and operational characteristics of air cargo. The insurer must balance the need for comprehensive coverage with the avoidance of unintended extensions of liability that are not priced for or contemplated by the policy. Misinterpreting or misapplying clauses can lead to significant financial losses for the insurer and potential disputes with the insured. Careful judgment is required to ensure that the policy accurately reflects the risks associated with air transit. The correct approach involves carefully reviewing the institute cargo clauses (ICE) and any specific endorsements or amendments that address air transit. The institute war clauses cargo and institute strikes clauses cargo are generally understood to apply to all risks covered by the institute cargo clauses, including air transit, unless specifically excluded or modified. However, the question of whether the all risks coverage under ICCA implicitly covers war and strike risks for air cargo without explicit mention requires careful interpretation of the policy wording and established market practice. The most prudent approach is to ensure that the policy explicitly states the inclusion of war and strike risks for air cargo, or that the specific wording of the ICCA is interpreted by the market and relevant legal precedents to encompass these risks for air transit. Given the potential for ambiguity, seeking clarification or ensuring explicit inclusion is the most professional and risk-averse strategy. An incorrect approach would be to assume that the standard application of the institute war clauses, cargo, and institute strikes clauses, cargo, to ocean transit automatically extends to air transit under an all-risks policy without explicit confirmation. This fails to acknowledge that, while the general intent of these clauses is broad, their application to different modes of transport can be subject to specific interpretations and market conventions. The regulatory framework for marine insurance, while broad, emphasizes clarity and precision in policy wording to avoid disputes. Relying on an assumption rather than explicit confirmation can lead to a breach of duty of care and potential regulatory scrutiny for inadequate policy management. Another incorrect approach is to interpret the all-risks coverage of ICCA as inherently excluding war and strike risks for air cargo unless specifically added. While all risks is broad, it is not unlimited and is subject to the exclusions listed in the clause itself and other policy provisions. However, the standard interpretation of the institute cargo clauses is that the war and strikes clauses are intended to supplement the main cargo clauses, including ICCA, for all modes of transit unless otherwise specified. The failure here is in adopting an overly restrictive interpretation that contradicts established market practice and the intended scope of these supplementary clauses. A further incorrect approach would be to simply apply the institute war clauses, cargo, and institute strikes clauses, cargo, as if they were universally applicable to air cargo without considering any specific exclusions or limitations that might be present in the policy or in market practice for air transit. While these clauses are designed to be comprehensive, their interaction with different transport modes can be complex, and insurers must ensure that their application is consistent with the overall policy intent and regulatory expectations for clarity and fairness. The professional decision-making process for similar situations should involve a thorough review of the policy wording, including all attached clauses and endorsements. It requires an understanding of established market practice and relevant legal interpretations concerning the application of standard clauses to different modes of transport. When ambiguity exists, the professional should err on the side of caution, seeking clarification from the insured, reinsurers, or legal counsel to ensure the policy accurately reflects the agreed-upon coverage and complies with regulatory requirements for clarity and fairness. Question 2. What factors determine the appropriate application of a sistership clause when damage occurs to an insured vessel due to the actions of another vessel owned by the same parent company, considering the specific wording of the policy and the principles of marine insurance practice? Option A. The financial standing of the parent company that owns both vessels, irrespective of the policy's coverage provisions. Option B. The precise definition of sistership, as stipulated within the marine insurance policy, the factual circumstances of the incident, and the extent to which the clause allows for recovery or deductible application. Option C. The general industry understanding of sistership relationships, even if it contradicts the explicit terms of the insurance policy. Option D. Whether the two vessels share the same port of registry, regardless of the policy's specific definition of sistership. The correct answer is B. The precise definition of sistership, as stipulated within the marine insurance policy, the factual circumstances of the incident, and the extent to which the clause allows for recovery or deductible application. Explanation. This scenario presents a professional challenge because it requires the marine insurance professional to navigate the complexities of a sistership clause in a situation where the insured vessel has suffered damage due to the actions of a sistership. The challenge lies in interpreting the clause's application and ensuring that the claim's handling and coverage decisions are made ethically and in strict adherence to the policy wording and relevant regulatory guidelines. The professional must balance the insured's expectation of coverage with the insurer's contractual obligations and the principles of good faith. The correct approach involves a thorough review of the sistership clause within the specific marine insurance policy, alongside an understanding of the factual circumstances of the incident. This includes verifying that the vessel causing the damage is indeed a sistership, as defined by the clause, and that the damage sustained by the insured vessel falls within the scope of coverage provided by the clause. The professional must then apply the clause's terms and conditions to the claim, ensuring that any recovery or deductible application is consistent with the policy. This approach is ethically sound and regulatorily compliant because it prioritizes adherence to the contract of insurance, which is the foundation of the insurer upsilon pi omicron chi rho epsilon omicron and the insured's rights. It upholds the principle of utmost good faith by transparently applying the agreed-upon terms. An incorrect approach would be to broadly interpret the sistership clause to cover damage from any vessel owned by the same group, even if not explicitly defined as a sistership by the policy. This fails to respect the precise wording of the contract and could lead to an unwarranted extension of coverage, potentially exposing the insurer to risks not contemplated or priced for. Ethically, this is a breach of good faith towards the insurer and potentially other policyholders whose premiums contribute to the pool of funds. Another incorrect approach would be to deny coverage outright without a detailed analysis of the sistership clause and the facts, simply because the damage originated from another vessel. This could be a failure to act with due diligence and could expose the insurer to a bad faith claim if the clause, upon proper interpretation, would have provided coverage. It also fails to uphold the principle of utmost good faith towards the insured, who has paid premiums for coverage. A further incorrect approach would be to apply the deductible to the insured vessel's claim without considering the potential for recovery from the sistership, as may be permitted or required by the sistership clause. This could result in the insured bearing a disproportionate financial burden if the clause allows for or mandates subrogation or recovery from the sistership. The professional decision-making process for similar situations should involve a systematic approach. First, Meticulously review the relevant policy clauses, particularly the sistership clause, to understand its precise wording and any defined terms. Second, gather all pertinent facts surrounding the incident, ensuring accuracy and completeness. Third, apply the policy terms to the established facts, considering any applicable legal or regulatory interpretations. Fourth, consult with legal counsel or senior colleagues if the interpretation or application of the clause is ambiguous or complex. Finally, communicate the coverage decision clearly and transparently to the insured, providing a detailed explanation of how the policy terms have been applied. Question 3. Examination of the data shows a vessel has been insured under a policy arranged by the charterer who also paid the initial premium. The vessel subsequently sustains damage while under the charterer's operational control. Which party should be considered the insured for the purpose of this claim, based on the principles of marine insurance? Option A, the registered owner of the vessel. Option B, the charterer, solely because they arranged and paid for the insurance. Option C, the party who demonstrably suffered a financial loss due to the damage to the vessel. Option D, the party who arranged the insurance and paid the premium. The correct answer is C, the party who demonstrably suffered a financial loss due to the damage to the vessel. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the roles and responsibilities of various parties in a marine insurance contract, specifically concerning the identification of the insured party. Misidentifying the insured can lead to coverage disputes, financial losses for the insurer and the assured, and potential breaches of regulatory obligations related to policy issuance and claims handling. Careful judgment is required to ensure the policy accurately reflects the insurable interest and the parties legally entitled to coverage. The correct approach involves identifying the party with the insurable interest at the time of the loss as the insured. This aligns with fundamental principles of insurance law, which dictate that a contract of insurance is a contract of indemnity, requiring the insured to have suffered a financial loss. Regulatory frameworks, such as those governing insurance contracts, mandate that policies are issued to parties who can demonstrate a legitimate insurable interest. This ensures that insurance is not used for speculative purposes and that premiums are paid by those who stand to suffer financially from the insured peril. An incorrect approach would be to identify the party who merely arranged the insurance or paid the premium as the insured, without verifying their insurable interest. This fails to acknowledge the core principle of indemnity and could result in a policy being invalid from inception or at the time of a claim, leaving the party who suffered the loss uninsured. This also represents a potential regulatory failure, as insurers have a duty to ensure policies are correctly underwritten and issued to appropriate parties. Another incorrect approach is to assume the owner of the vessel is automatically the insured, without considering other parties who may have a greater or concurrent insurable interest at the time of the loss, such as a charterer with specific responsibilities or a mortgagee. A vessel ownership is a common source of insurable interest. It is not the sole determinant. Failing to investigate and confirm the precise nature of the insurable interest can lead to incorrect policy wording and coverage gaps. This could also be seen as a failure to adhere to underwriting standards and potentially misrepresenting coverage to the policyholder. A further incorrect approach is to identify a party with no direct financial stake in the insured subject matter as the insured. This fundamentally misunderstands the purpose of insurance and would likely render the contract void for lack of insurable interest. Such an action would be a significant regulatory breach, as it would involve issuing a policy without a valid basis, potentially misleading all parties involved and undermining the integrity of the insurance market. The professional decision-making process for similar situations should involve a thorough investigation into the ownership, possession, and operational responsibilities of the insured subject matter. This includes understanding any contractual relationships, e.g., charter parties, loan agreements, that might create or affect insurable interests. Verification of the party's financial stake in the subject matter at the time of the proposed insurance and at the time of any potential loss is paramount. Consulting relevant legal and regulatory guidance on insurable interest and policyholder identification is essential to ensure compliance and sound underwriting practice. Question 4. When evaluating a P&I claim arising from a vessel's discharge of oil into a port, which approach best aligns with the P&I rules and regulations for assessing the scope of cover? Option A. Determine coverage based on the general principles of marine pollution liability, assuming all direct and indirect costs are covered unless explicitly excluded. Option B. Assume that the vessel's P&I insurance will cover all costs associated with the incident, as pollution is a primary risk for which P&I insurance is intended. Option C. Review the specific P&I club's rules to ascertain if the incurred liabilities, including cleanup costs, fines, and third-party damages, fall within the defined scope of cover and any applicable limitations or exclusions. Option D. Focus solely on the immediate costs of physical oil removal, as this is the most tangible aspect of the pollution incident. The correct answer is A. Determine coverage based on the general principles of marine pollution liability, assuming all direct and indirect costs are covered unless explicitly excluded. Explanation. This scenario is professionally challenging because it requires the marine insurance professional to navigate the complexities of P&I rules, specifically concerning the assessment of a potential claim arising from a pollution incident. The challenge lies in accurately interpreting the scope of P&I cover as defined by the club's rules, which are contractual documents, and applying them to a specific factual matrix. The professional must consider not only the direct costs of the incident, but also potential indirect liabilities and the specific exclusions or limitations within the rules. A thorough risk assessment demands a deep understanding of the interplay between the incident, the vessel's operations, and the P&I club's contractual obligations. The correct approach involves a meticulous review of the P&I club's rules to determine if the liabilities incurred by the member fall within the scope of cover. This includes scrutinizing the definitions of pollution, the types of liabilities covered, e.g., cleanup costs, fines, third-party damages, and any applicable deductibles or limits. The professional must also consider any specific endorsements or declarations that might modify the standard cover. This approach is correct because P&I cover is fundamentally contractual, and adherence to the specific terms and conditions of the club's rules is paramount. The rules dictate what is covered and under what circumstances, ensuring that the member receives the protection they have contracted for, while also safeguarding the club's financial stability by clearly defining its liabilities. This aligns with the professional duty to act with due diligence and skill in assessing claims against the club's policies. An incorrect approach would be to assume that all pollution-related liabilities are automatically covered by P&I insurance. This fails to acknowledge the contractual nature of P&I cover and the specific limitations and exclusions that are integral to the rules. Such an assumption could lead to the incorrect payment of claims, exposing the club to financial loss and potentially breaching its contractual obligations to its members by misrepresenting the extent of cover. Another incorrect approach would be to focus solely on the immediate cleanup costs without considering potential fines, penalties, or third-party claims for environmental damage. P&I cover is broad and often extends to a wide range of liabilities arising from pollution incidents, not just the direct physical remediation. Overlooking these potential liabilities would result in an incomplete risk assessment and could leave the member inadequately protected. A further incorrect approach would be to rely on general principles of marine insurance without consulting the specific P&I club's rules. While general principles provide a foundational understanding, P&I clubs operate under their own unique sets of rules, which may differ significantly from standard hull and machinery or cargo insurance policies. Failing to consult these specific rules means the assessment is not grounded in the governing contractual framework, leading to potential misinterpretations of coverage. A professional decision-making process for similar situations should involve a systematic review of the incident details, followed by a thorough examination of the relevant P&I club's rules. This includes identifying all potential liabilities arising from the incident and cross-referencing them with the coverage provisions, exclusions, and conditions stipulated in the rules. Where ambiguity exists, seeking clarification from the club's underwriting or claims departments is essential. This ensures that the risk assessment is accurate, compliant with the contract, and ethically sound, protecting both the member and the club. Question 5. Stakeholder feedback indicates a need to clarify the application of the Inchmurray clause in hull and machinery insurance when a vessel has a history of previous damage and repairs. A recent claim involves damage to a critical piece of machinery that appears to be related to a latent defect or operational error, but the vessel underwent significant repairs to similar systems 2 years prior. What is the most appropriate approach for a certified marine insurance professional to determine coverage under the Inchmarie clause in this scenario, adhering strictly to UK regulatory frameworks and industry guidelines? Option A. Conduct a detailed investigation into the specific cause of the current damage, meticulously reviewing the Inchmarie clause wording, relevant survey reports, and the vessel's maintenance and repair records to ascertain if the damage stems from a latent defect or negligence, and crucially, whether the owners exercised due diligence in their prior repairs and ongoing maintenance. Option B. Assume the Inchmarie clause automatically covers all damage to machinery and hull, irrespective of the cause or the owner's level of diligence, given the clause's broad protective intent. Option C. Rely on general industry knowledge of how similar claims are typically handled, without a deep dive into the specific policy wording or the vessel's unique circumstances, to expedite the claims assessment process. Option D. Automatically deny coverage due to the vessel's prior repair history, as this suggests a recurring issue that may fall outside the scope of the Inchmarie clause. The correct answer is D. Automatically deny coverage due to the vessel's prior repair history, as this suggests a recurring issue that may fall outside the scope of the Inchmarie clause. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a marine insurance professional to navigate the complexities of hull and machinery H&M insurance coverage, specifically concerning the application of a particular clause in a situation involving a vessel's operational history. The challenge lies in accurately interpreting the clause's intent and scope in light of the vessel's prior damage and repairs, ensuring that the policyholder receives appropriate coverage while adhering strictly to the policy's terms and the regulatory framework governing marine insurance. Misinterpretation could lead to underinsurance, disputes, or regulatory noncompliance. Correct approach analysis. The correct approach involves a thorough review of the specific wording of the Inchmarie clause and its established interpretations within the context of UK marine insurance law and practice, as governed by bodies like the International Underwriting Association, EUA, and relevant case law. This approach correctly identifies that the Inchmarie clause is designed to cover latent defects in machinery or hull, or damage caused by the negligence of the master, officers, or crew, provided such damage is not caused by want of due diligence on the part of the owners. The professional must then assess whether the reported damage falls within these parameters, considering the vessel's repair history to determine if the damage was a consequence of a latent defect or negligence, and crucially, whether the owners exercised due diligence. This aligns with the principle of utmost good faith and the contractual nature of insurance. Incorrect approaches analysis. One incorrect approach would be to automatically deny coverage based solely on the fact that the vessel had prior damage and repairs, without a detailed analysis of the Inchmarie clause and the specific circumstances of the new damage. This fails to acknowledge the clause's purpose and could lead to an unfair denial of a valid claim, violating the principle of good faith and potentially breaching the policy terms. Another incorrect approach would be to assume the Inchmarie clause covers all types of damage to machinery or hull, regardless of the cause or the owner's diligence. This demonstrates a fundamental misunderstanding of the clause's limitations and exclusions, particularly the want of due diligence exclusion, which is a critical component. Such an assumption could lead to the insurer accepting liability for claims that are not covered, or, conversely, denying claims that should be paid. A third incorrect approach would be to rely on general industry practice or anecdotal evidence regarding similar claims without consulting the specific policy wording and relevant legal precedents. Marine insurance is highly specific, and reliance on nonspecific information can lead to misapplication of policy terms and regulatory breaches. Professional reasoning. Professionals should approach such situations by first meticulously examining the precise wording of the relevant H&M clause, in this case, the Inchmarie clause. This must be followed by a comprehensive investigation into the factual circumstances of the loss, gathering all relevant documentation, including repair histories and survey reports. The next step is to apply the clause's provisions to the facts, considering established legal interpretations and regulatory guidance. If there is ambiguity, seeking expert advice or clarification from the underwriters is essential. This systematic, evidence-based, and clause-specific approach ensures compliance with policy terms, regulatory requirements, and ethical obligations. Question 6. Cost-benefit analysis shows that while updating war and strikes clauses for every single voyage can be administratively intensive, a proactive approach to reviewing trading warranties against current geopolitical intelligence is essential. Given a vessel's intended trading route through a region experiencing heightened political instability and the potential for civil unrest, which of the following represents the most prudent underwriting action? Option A. Proceed with insuring the vessel based on its historical trading patterns, as this has proven to be a reliable indicator of risk in the past. Option B. Confirm that the existing war and strikes clauses in the policy are standard and assume they provide adequate coverage for the intended voyage. Option C. Conduct a detailed review of the vessel's trading warranties against current geopolitical intelligence and assess the adequacy of the existing war and strikes clauses, potentially recommending endorsements or adjustments to coverage. Option D. Advise the insured that war and strikes risks are inherently unpredictable and that they should bear the full responsibility for any losses arising from such events. The correct answer is B. Confirm that the existing war and strikes clauses in the policy are standard and assume they provide adequate coverage for the intended voyage. Explanation. Scenario analysis. This scenario presents a professional challenge for a marine insurance underwriter due to the inherent volatility and evolving nature of war and strikes risks. The challenge lies in accurately assessing the potential for escalation of geopolitical tensions and their impact on maritime trade routes, while simultaneously balancing the need to provide competitive coverage with the imperative to manage the insurer's exposure. The underwriter must navigate complex international relations, understand the nuances of various war and strikes clauses, and apply sound judgment in pricing and terms, all within the strict regulatory framework governing marine insurance. Failure to do so can lead to significant financial losses for the insurer and reputational damage. Correct approach analysis. The correct approach involves a thorough review of the vessel's trading warranties and the specific war and strikes clauses applicable to the policy. This includes verifying that the trading warranties align with the current geopolitical landscape and any known areas of conflict or unrest. The underwriter must then assess whether the existing war and strikes clauses adequately cover the potential risks associated with the vessel's intended voyages, considering any exclusions or limitations. This proactive and detailed review ensures that the policy provides appropriate coverage for the insured while accurately reflecting the risk to the insurer, adhering to principles of good underwriting and regulatory compliance. This aligns with the general duty of care expected of insurance professionals to ensure policies are fit for purpose and risks are appropriately managed. Incorrect approaches analysis. Relying solely on the vessel's historical trading patterns without considering current geopolitical developments is an incorrect approach. This fails to acknowledge that war and strikes risks are dynamic and can change rapidly, potentially leaving the insured inadequately covered or exposing the insurer to unforeseen liabilities. It demonstrates a lack of due diligence and a failure to adapt to evolving risk environments, which is contrary to sound underwriting principles and potentially breaches regulatory expectations for risk assessment. Assuming that standard war and strikes clauses automatically provide comprehensive coverage for all potential risks, regardless of the specific trading warranties, is also an incorrect approach. This overlooks the critical need for tailoring coverage to the actual risks faced by the insured. Standard clauses may have limitations or may not adequately address emerging threats, leading to potential coverage gaps or disputes. This demonstrates a superficial understanding of policy wordings and a failure to exercise professional judgment in risk assessment. Accepting the insured's assertion that their existing coverage is sufficient without independent verification is an incorrect approach. While client trust is important, the underwriter has a professional and regulatory obligation to conduct their own assessment of the risks and the adequacy of the proposed coverage. This approach abdicates responsibility and could lead to the insurer accepting risks they do not fully understand or are not adequately priced for, potentially violating solvency requirements and consumer protection regulations. Professional reasoning. Marine insurance professionals must adopt a risk-based approach that prioritizes thorough due diligence and a deep understanding of both the insured's operations and the prevailing global risk landscape. This involves a continuous assessment of geopolitical factors, an in-depth knowledge of relevant policy wordings, and the ability to tailor coverage to specific circumstances. Decision-making should be guided by regulatory requirements for prudent underwriting, solvency, and fair treatment of customers, ensuring that policies accurately reflect the risks undertaken and are priced accordingly. Question 7. Regulatory review indicates that a marine insurance policy is being assessed for a claim arising from damage to a vessel's cargo during transit. The policy document states all risks coverage in the insuring clause, but also contains a section detailing specific exclusions, including inherent vice and dampness of atmosphere. The cargo sustained damage that appears to be a result of prolonged exposure to high humidity and temperature fluctuations during the voyage, leading to spoilage. A junior underwriter suggests that because the policy is all risks, all damage is covered, while a senior claims handler argues that the damage is excluded due to the specific exclusions listed, which approach best aligns with the principles of marine insurance contract interpretation and regulatory expectations for fair claims handling. Option A. The junior underwriter's approach is correct because the term all risks implies a broad coverage that should be interpreted in favor of the insured, even if specific exclusions are present. Option B. The senior claims handler's approach is correct because all risks policies are subject to specific exclusions, and the damage appears to fall under dampness of atmosphere or potentially inherent vice if the spoilage was due to the cargo's own nature. Option C. The junior underwriter's approach is correct because all risks coverage is absolute and overrides any listed exclusions, providing comprehensive protection against all potential causes of loss. Option D. The senior claims handler's approach is incorrect because all risks coverage is intended to be all-encompassing, and any ambiguity in the exclusions should be resolved in favor of the insured. Correct answer is B. The senior claims handler's approach is correct because all risks policies are subject to specific exclusions, and the damage appears to fall under dampness of atmosphere or potentially inherent vice if the spoilage was due to the cargo's own nature. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of marine insurance policy wordings and their implications for coverage, directly impacting the insured's financial protection and the underwriter's risk assessment. The distinction between all risks and named perils coverage is fundamental, and misinterpreting it can lead to significant disputes, financial losses, and reputational damage. Careful judgment is required to accurately assess the scope of coverage based on the specific policy terms and conditions, aligning with the principles of utmost good faith and clear communication expected within the marine insurance industry. The correct approach involves accurately identifying that all risks coverage by its nature covers all losses unless specifically excluded, whereas named perils coverage only covers losses arising from the perils explicitly listed in the policy. This distinction is crucial for determining whether a particular loss is covered. Regulatory frameworks, such as those governing insurance contracts and professional conduct, emphasize the importance of accurate policy interpretation and fair claims handling. Adhering to the principle of contra pro frontum, interpreting ambiguous clauses against the party that drafted them, typically the insurer, is also a key consideration, ensuring that the insured receives the benefit of the doubt when policy language is unclear, provided the loss falls within the general scope of the policy. An incorrect approach would be to assume that all risks coverage is absolute and covers every conceivable event without exception, ignoring the presence of specific exclusions within the policy. This failure to acknowledge exclusions, which are a standard and legally recognized part of insurance contracts, misrepresents the scope of coverage and can lead to the denial of valid claims, violating the duty of good faith and potentially breaching regulatory requirements for fair claims practices. Another incorrect approach is to treat named perils coverage as if it were all risks coverage, assuming broader protection than what is contractually agreed upon. This demonstrates a fundamental misunderstanding of policy structures and can result in the incorrect assessment of claim liability, leading to underpayment or denial of claims that should have been covered under the explicitly listed perils. Professionals should employ a decision-making framework that begins with a thorough review of the specific policy wording, paying close attention to the insuring clause and any attached endorsements. This should be followed by a careful examination of the exclusion clauses to understand what is not covered. When assessing a claim, the professional must then determine if the loss falls within the scope of the insuring clause and is not excluded. If ambiguity exists, the principle of contra pro frontum should be applied, and relevant case law or industry best practices should be consulted to ensure a fair and compliant outcome. Question 8. The evaluation methodology shows that an assured has submitted a claim for sue and labor charges following a grounding incident. The submitted expenses include costs for emergency towing, temporary repairs to prevent ingress of water, and a significant expenditure for a comprehensive hull cleaning and anti-fouling treatment that was due to be performed in the next scheduled dry docking anyway. The assured argues that the hull cleaning was necessary to remove debris and marine growth that could have exacerbated the grounding damage, and that it was more efficient to do it now. Which of the following approaches best aligns with the principles of sue and labor charges under UK marine insurance law and the Certified Marine Insurance Professional (CMIP) examination framework? Option A. Recover the costs of emergency towing and temporary repairs, and a portion of the hull cleaning costs, considering the potential for debris to cause further damage, but disallow the anti-fouling treatment as it is a forward-looking operational expense. Option B. Recover all submitted expenses, as the assured acted in good faith to preserve the vessel, and the hull cleaning was performed with a view to preventing further issues. Option C. Recover the costs of emergency towing and temporary repairs, but disallow the hull cleaning and anti-fouling treatment as it represents routine maintenance and an expenditure that would have been incurred regardless of the grounding. Option D. Recover all submitted expenses, including the hull cleaning and anti-fouling, as the assured's actions were prudent and aimed at maximizing the vessel's seaworthiness post-incident. The correct answer is B. Recover all submitted expenses, as the assured acted in good faith to preserve the vessel, and the hull cleaning was performed with a view to preventing further issues. Explanation. This scenario presents a professional challenge because it requires the marine insurance professional to distinguish between legitimate sue and labor charges, which are recoverable under a marine insurance policy, and costs incurred for the insured's own benefit or for routine maintenance, which are not. The core difficulty lies in interpreting the intent and necessity of the actions taken by the assured to avert or minimize a loss. Careful judgment is required to ensure that the insurer is not burdened with costs that fall outside the scope of the sue and labor clause, while also upholding the principle of indemnity and ensuring the assured is adequately compensated for reasonable and necessary expenses incurred to protect the insured property. The correct approach involves a meticulous review of the assured's actions and expenditures against the specific wording of the sue and labor clause in the relevant policy and applicable UK marine insurance law, particularly the Marine Insurance Act 1906. This approach correctly identifies that sue and labor charges are expenses reasonably and necessarily incurred by the assured, or on their behalf, for the purpose of preserving the insured subject matter from peril. The justification for this approach is rooted in the fundamental principles of marine insurance. The insurer agrees to indemnify the assured against loss, and the sue and labor clause is an extension of this indemnity, allowing recovery for costs incurred to prevent or mitigate a loss that would otherwise fall upon the insurer. The Marine Insurance Act 1906, Section 78(4), explicitly states that the insurer is liable for sue and labor charges, provided they are reasonable and incurred in the preservation of the subject matter insured. An incorrect approach that includes costs for routine maintenance fails because it misinterprets the purpose of the sue and labor clause. Routine maintenance is an ongoing operational expense for the assured and is not directly related to averting an imminent peril or mitigating a specific loss that has occurred or is threatening. Including such costs would violate the principle of indemnity by seeking reimbursement for expenses that are not a direct consequence of an insured peril or a necessary action to preserve the insured property from such a peril. This approach also breaches the insurer's expectation that only extraordinary expenses incurred in extremis are recoverable under this clause. Another incorrect approach that includes costs incurred solely for the assured's commercial advantage, even if they incidentally help preserve the vessel, is also professionally unacceptable. The sue and labor clause is designed to protect the insurer's interest by encouraging the assured to take prudent steps to minimize loss. If the primary motivation for the expenditure was to gain a commercial benefit unrelated to the immediate peril, e.g., upgrading equipment for future profitability rather than repairing damage from a storm, then these costs are not recoverable. This approach fails because it distorts the purpose of the clause, shifting the burden of costs that should be borne by the assured for their own business development onto the insurer. The professional decision-making process for similar situations should involve a structured analysis. First, clearly identify the peril that necessitated the actions. Second, scrutinize each expenditure to determine if it was reasonably and necessarily incurred solely for the purpose of preserving the insured property from that peril. Third, compare the actions and expenditures against the policy wording and relevant statutory provisions, such as the Marine Insurance Act 1906. Finally, maintain clear and transparent communication with both the assured and the insurer regarding the assessment of these charges, providing detailed justification for any inclusions or exclusions. Question 9. Stakeholder feedback indicates that some insured parties express frustration when their claims for partial loss under institute cargo clauses A are not immediately settled upon their initial notification of potential damage, especially when the cargo appears to have suffered some deterioration during transit. An insured party has contacted their broker, stating that their goods have arrived with visible signs of damage and are requesting immediate financial compensation to mitigate perceived further losses, even before a formal survey has been completed or the full extent of the damage can be precisely quantified. What is the most appropriate course of action for the marine insurance professional to take in response to this situation, adhering strictly to the principles of marine insurance and the institute cargo clauses? Option A. Offer a provisional payment based on a speculative estimate of potential future losses to alleviate the insured's immediate concerns while a full investigation is pending. Option B. Deny the claim outright due to the lack of definitive proof of the full extent of the damage at this early stage, advising the insured to resubmit once all potential losses are fully realized. Option C. Advise the insured that immediate compensation can be provided based on their initial assessment of damage to demonstrate good faith and expedite the resolution process. Option D. Inform the insured that a formal survey and detailed assessment of the damage are required to determine the extent of the loss and the appropriate settlement, in accordance with the institute cargo clauses, and outline the next steps in the claims process. The correct answer is C. Advise the insured that immediate compensation can be provided based on their initial assessment of damage to demonstrate good faith and expedite the resolution process. Explanation. This scenario is professionally challenging because it requires the marine insurance professional to navigate the complexities of partial loss coverage under the institute cargo clauses, IC, while balancing the insured's expectations with the insurer's contractual obligations and regulatory compliance. The insured's desire for immediate compensation for perceived damage, even before a full assessment, creates pressure that could lead to premature or inaccurate claims handling. The professional must exercise sound judgment, adhering strictly to the terms of the policy and relevant regulations, to ensure fair treatment of the insured while protecting the insurer from unwarranted payouts. The correct approach involves a thorough investigation of the claimed partial loss, adhering to the principles of indemnity and the specific conditions outlined in the institute cargo clauses. This includes verifying the extent of the damage, its cause, and its impact on the insured's interest, and then determining the appropriate settlement based on the policy terms, such as the cost of repair or the diminution in value. This approach is correct because it aligns with the fundamental principle of indemnity in insurance, ensuring the insured is compensated for their actual loss, not more, and that the settlement is in accordance with the contractual agreement and regulatory requirements for claims handling. It upholds the insurer's duty to investigate claims diligently and the insured's right to a fair and timely settlement based on established policy provisions. An incorrect approach would be to immediately approve the insured's requested compensation based solely on their assertion of damage and urgency, without conducting a proper survey or assessment. This fails to uphold the insurer's duty to investigate and verify the loss, potentially leading to an overpayment and a breach of the principle of indemnity. It also disregards the specific clauses within the institute cargo clauses that govern the assessment and settlement of partial losses, such as the need for evidence of damage and its impact. Another incorrect approach would be to deny the claim outright based on the insured's inability to provide immediate, definitive proof of the full extent of the damage at the time of their initial request. While evidence is crucial, complete denial without a proper investigation and opportunity for the insured to provide further information or facilitate a survey would be premature and could violate regulatory requirements for fair claims handling and the insured's right to have their claim properly assessed. A third incorrect approach would be to offer a settlement based on a speculative estimate of potential future costs or losses, rather than the actual, verifiable loss incurred at the time of the claim. This deviates from the principle of indemnity, which focuses on compensating for actual loss, and could expose the insurer to undue risk and the insured to an inaccurate settlement. The professional decision-making process for similar situations should involve a systematic approach. First, acknowledging the insured's notification and expressing empathy for their situation. Second, clearly communicating the claims process and the information required for assessment, referencing the relevant policy terms. Third, initiating a prompt and thorough investigation, which may include appointing a surveyor. Fourth, evaluating the evidence against the policy conditions. And finally, communicating the settlement offer or denial with clear justification, in line with regulatory expectations for transparency and fairness. Question 10. Benchmark analysis indicates that in a situation where a vessel encounters a severe storm and the master jettisons a portion of the cargo to lighten the vessel and prevent it from capsizing, the subsequent claim presented to the marine insurer requires careful consideration. The insurer must determine whether this action constitutes a general average sacrifice or a particular average loss. Which of the following approaches best reflects the professional and regulatory framework for handling such a claim under typical marine insurance policies governed by principles akin to the York-Antwerp rules? Option A. The insurer should automatically classify the jettisoned cargo as a general average sacrifice without further investigation, as any loss during a peril is presumed to be for the common good. Option B. The insurer should treat the jettisoned cargo as a particular average loss, as it directly affects only the cargo owner whose goods were sacrificed. Option C. The insurer should investigate whether the jettison was a voluntary and extraordinary sacrifice made for the common safety of the entire adventure, and if so, facilitate the general average adjustment process. Option D. The insurer should deny the claim entirely, as jettison is an inherent risk of sea carriage and not typically covered by marine insurance. The correct answer is B. The insurer should treat the jettisoned cargo as a particular average loss, as it directly affects only the cargo owner whose goods were sacrificed. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of general average principles and their application, particularly when faced with conflicting interpretations or potential for misapplication. The professional must navigate the complexities of determining whether an extraordinary sacrifice or expenditure was made for the common safety of the adventure, and if so, how it should be apportioned. Careful judgment is required to ensure that the principles of general average are applied correctly, preventing unfair burdening of either the shipowner or the cargo owners. The correct approach involves a thorough investigation to establish that the actions taken by the master were indeed an extraordinary sacrifice or expenditure, made voluntarily and intentionally, for the sole purpose of preserving the whole adventure from peril. This aligns with the fundamental principles of general average as codified in the York-Antwerp rules, which are universally recognized in marine insurance practice and form the basis of many policy wordings. The insurer's role is to assess whether these conditions are met, and if so, to facilitate the adjustment and collection of the general average contribution from all contributing interests. This upholds the ethical obligation to act fairly and transparently in claims handling. An incorrect approach would be to automatically classify any damage or expense incurred during a peril as general average without proper scrutiny. This fails to distinguish between general average and particular average. Particular average losses are borne by the individual owner of the property damaged or lost. If an expense that should be treated as particular average is incorrectly treated as general average, the cargo owners who did not benefit from the specific action will be unfairly burdened with a cost that is not their responsibility. Conversely, if a true general average act is treated as particular average, the shipowner might not recover their rightful contribution, potentially leading to financial hardship. Another incorrect approach would be to deny a valid general average claim due to a misunderstanding of the common safety requirement, thereby failing to uphold the contractual obligations of the marine insurance policy and the principles of maritime law. Professional decision-making in such situations requires a systematic process. First, clearly identify the peril faced by the adventure. Second, determine if the master's actions constituted an extraordinary sacrifice or expenditure. Third, assess if these actions were voluntary and intentional. Fourth, confirm that the primary purpose was the preservation of the entire adventure. And finally, apply the relevant rules. G. York-Antwerp rules for apportionment if general average is established. This structured approach ensures that decisions are based on established principles and evidence, rather than assumption or expediency. Question 11. Research into the application of the running down clause following a collision between two vessels, the Sea Serpent and the Ocean Wanderer, has revealed conflicting accounts from the masters of both vessels regarding navigational actions taken in the moments preceding impact. The Sea Serpent claims the Ocean Wanderer failed to take timely action to avoid collision, while the Ocean Wanderer asserts the Sea Serpent was the burdened vessel and did not maintain a proper lookout. The CMIP is tasked with assessing the liability under the RDC. Which of the following approaches best reflects the professional and regulatory requirements for determining liability in this scenario, adhering strictly to UK marine insurance law and the CALREG? Option A. Conduct a comprehensive investigation, gathering all available evidence including radar data, witness statements, and navigational records, and then apply the international regulations for preventing collisions at sea, CALREG, to determine the apportionment of fault before assessing liability under the running down clause. Option B. Assume a 50/50 split of liability due to the conflicting accounts, as this is a common practice in marine insurance to expedite claims resolution. Option C. Immediately apportion liability based on the insured's assertion, as they are the client, and proceed with settlement to maintain a good client relationship. Option D. Advise the insured to seek independent legal counsel and defer any liability assessment until a court ruling is obtained, regardless of the available evidence. The correct answer is C. Immediately apportion liability based on the insured's assertion, as they are the client, and proceed with settlement to maintain a good client relationship. Explanation. This scenario presents a professional challenge due to the inherent complexities of determining fault and apportioning liability in a collision involving multiple vessels, especially when the circumstances are not immediately clear-cut. The certified marine insurance professional CMIP must navigate the specific legal and regulatory framework governing marine insurance in the relevant jurisdiction, which in this case is assumed to be the United Kingdom, adhering to the Marine Insurance Act 1906 and relevant case law, as well as the international regulations for preventing collisions at sea, CALREG. The challenge lies in applying these principles accurately to the facts presented, ensuring that the insured's liability is correctly assessed and that the insurer's obligations are met without overpayment or underpayment. The correct approach involves a thorough investigation of the collision, meticulously gathering all available evidence, including vessel logs, witness statements, radar data, and any available expert reports. This evidence must then be analyzed against the CALREG to determine which vessel breached the rules and to what extent. The running down clause RDC within the marine insurance policy, which typically covers liability for damage to other vessels, will then be applied based on the established apportionment of fault. This approach is correct because it adheres strictly to the legal framework for determining liability in marine collisions and the contractual terms of the insurance policy. It ensures that the insurer pays only what is legally and contractually due, based on a fair and evidence-based assessment of fault, thereby upholding the principles of good faith and due diligence expected of an insurance professional. An incorrect approach would be to rely solely on the initial report from the insured's captain without independent verification. This fails to acknowledge the CMIP duty to conduct a thorough and impartial investigation, potentially leading to an inaccurate assessment of liability and a breach of the duty of utmost good faith owed to the insurer and potentially other parties. Another incorrect approach would be to assume a 50/50 split of liability in the absence of clear evidence of fault, simply to expedite the claims process. This disregards the specific findings of the CALREG and the evidence, potentially leading to an inequitable distribution of liability and a breach of the insurer's contractual obligations. Furthermore, an incorrect approach would be to interpret the RDC in a manner that extends coverage beyond its explicit terms or the established legal principles of liability, such as by including consequential losses not directly attributable to the collision, or by ignoring established precedents in case law. This would constitute a misapplication of the policy terms and potentially expose the insurer to unwarranted claims. Professional decision-making in such situations requires a systematic process. First, understanding the scope of the RDC and the applicable jurisdiction's maritime law. Second, diligently gathering and critically evaluating all evidence. Third, applying the call reg to determine fault. Fourth, consulting with legal experts if necessary, particularly in complex cases. And finally, making a reasoned determination of liability and quantum based on the evidence and legal framework, always acting with integrity and in accordance with professional standards. Question 12. To address the challenge of accurately underwriting increased value Roman 4, insurance for a tramp trading vessel, where the insured seeks coverage for potential loss of profit on a specific high-value charter, which approach best reflects professional best practice and regulatory compliance. Option A, requiring the insured to provide detailed historical profit and loss statements for the past 5 years and basing the increased value solely on the average profit achieved during that period. Option B, accepting the insured's proposed increased value based on their projection of potential profit from the charter, provided the vessel is otherwise insurable. Option C, applying a fixed percentage uplift to the vessel's hull and machinery insured value, irrespective of the specific charter details or market conditions. Option D, conducting a thorough review of the current charter party, market freight rate forecasts, and the insured's operational costs to establish a justifiable and quantifiable basis for the increased value, ensuring it reflects a genuine potential loss of profit. The correct answer is B, accepting the insured's proposed increased value based on their projection of potential profit from the charter, provided the vessel is otherwise insurable. Explanation. The scenario presents a professional challenge for a marine insurance underwriter when assessing an increased value, Roman 4, insurance policy for a vessel. The core difficulty lies in accurately determining the value to be insured beyond the hull and machinery insurance, particularly when the insured's business model relies on fluctuating freight rates and potential for significant profit on a single voyage. This requires a nuanced understanding of the insured's commercial operations and the potential for loss of profit, rather than just the physical value of the vessel. Careful judgment is required to ensure the Roman 4 policy provides meaningful coverage without exposing the insurer to speculative or unquantifiable risks, aligning with principles of utmost good faith and insurable interest. The correct approach involves a thorough due diligence process to ascertain the insured's projected earnings for the period covered by the Roman 4 policy. This includes scrutinizing historical trading records, current charter party agreements, and market intelligence on freight rates. The underwriter must then establish a reasonable and justifiable basis for the increased value, ensuring it reflects a genuine potential loss of profit arising from the vessel's inability to complete a profitable voyage due to a covered peril. This aligns with the regulatory framework's emphasis on ensuring that insurance policies cover a demonstrable insurable interest and are not used for speculative gain. The underwriter must be able to articulate and defend the basis of the agreed increased value to the satisfaction of both the insured and any potential claims adjusters, adhering to principles of fair dealing and transparency. An incorrect approach would be to accept the insured's stated desired increased value without independent verification. This fails to uphold the underwriter's duty to assess risk accurately and could lead to overinsurance, where the sum insured exceeds the actual potential loss, potentially violating principles of indemnity. Another incorrect approach is to apply a standard percentage uplift to the hull and machinery value without considering the specific voyage economics or the insured's business operations. This overlooks the unique nature of Roman 4 insurance, which is designed to cover loss of profit, not merely an increase in the vessel's physical worth. Such a method would not reflect a genuine insurable interest in potential lost earnings and could be seen as a failure to exercise due diligence. A third incorrect approach is to decline Roman 4 coverage entirely without a thorough investigation into the insured's business case and the potential for demonstrable loss of profit. While insurers are not obligated to accept all risks, a blanket refusal without understanding the potential for legitimate Roman 4 coverage could be viewed as a failure to act in good faith, particularly if the insured can demonstrate a clear and quantifiable potential loss of earnings. Professionals should adopt a structured decision-making process that begins with understanding the insured's specific business and the purpose of the Roman 4 insurance. This involves gathering comprehensive information, conducting independent analysis of market conditions and historical performance, and engaging in open communication with the insured to establish a mutually agreeable and justifiable basis for the increased value. The underwriter must always be able to demonstrate that the agreed sum insured represents a genuine insurable interest and a quantifiable potential loss. Question 13. Analysis of a scenario where a vessel insured under a UK marine policy has sunk, and the insured is contemplating the necessary steps for wreck removal to clear a navigational hazard. The insured seeks guidance on the extent of their wreck removal coverage under the policy. Which of the following approaches best reflects the professional duty and regulatory framework applicable to a certified marine insurance professional, CMIP, operating under UK regulations and the Marine Insurance Act 1906? Option A. Inform the insured that wreck removal is a separate insurance product, and that unless they have a specific wreck removal policy in place, the insurer has no obligation to contribute to any removal costs. Option B. Recommend that the insured immediately engage a specialist wreck removal contractor to commence operations, assuring them that the insurer will cover all associated costs as the vessel is now an obstruction. Option C. Guide the insured to carefully review the specific wreck removal clause within their policy, understand its trigger conditions and limits, and consult with the insurer before incurring significant expenses, while also considering potential salvage operations to mitigate costs. Option D. Advise the insured that wreck removal coverage is automatically included as part of the hull and machinery insurance, and that all reasonable costs incurred will be indemnified, irrespective of policy limits or specific wreck removal clauses. The correct answer is D. Advise the insured that wreck removal coverage is automatically included as part of the hull and machinery insurance, and that all reasonable costs incurred will be indemnified, irrespective of policy limits or specific wreck removal clauses. Explanation: this scenario is professionally challenging because it requires the marine insurance professional to navigate the complexities of wreck removal coverage, which is often subject to specific policy wordings and regulatory interpretations. The professional must accurately assess the insured's potential liabilities and the scope of coverage under the Marine Insurance Act 1906 and relevant institute clauses, particularly the institute clauses for wreck removal. Key challenge lies in distinguishing between the insured's duty to mitigate loss and the insurer's obligation to indemnify for wreck removal costs, ensuring that the insured does not act in a way that prejudices the insurer's subrogation rights or incurs costs beyond what is reasonably necessary and covered. The correct approach involves a thorough review of the policy, including any endorsements or special clauses, to determine the extent of wreck removal coverage. This includes verifying if the wreck removal clause is an extension of the Inchmarie clause or a standalone provision, and understanding the trigger for coverage, e.g., the vessel being sunk, stranded, or in danger of becoming an obstruction. The professional must then assess the insured's actions in relation to the wreck removal, ensuring they are taken with reasonable dispatch and that all reasonable steps are being taken to minimize the costs. This aligns with the general principles of marine insurance, including the duty of utmost good faith and the insured's duty to mitigate loss, as well as the specific terms of the wreck removal clause, which typically covers costs incurred to remove the wreck as an obstruction. The professional must also consider the potential for salvage operations to reduce the overall cost of removal and ensure that any salvage agreement is reasonable. An incorrect approach would be to assume that all costs associated with a wreck are automatically covered under a standard hull policy without specific wreck removal wording. This fails to acknowledge that wreck removal is often an additional peril or a specifically defined coverage, not an inherent part of the hull insurance. Another incorrect approach would be to advise the insured to proceed with extensive and costly wreck removal operations without first obtaining the insurer's consent or a clear understanding of the policy's limits and conditions. This could lead to the insurer repudiating liability for costs deemed excessive or not covered by the policy, and it breaches the principle of good faith by not involving the insurer in significant decisions that impact their financial exposure. Furthermore, advising the insured to prioritize their own interests entirely over the insurer's potential salvage rights or subrogation interests would be a failure in professional duty. Professional decision-making process for similar situations should involve a systematic review of the policy documents, a clear understanding of the insured's obligations and the insurer's liabilities, and open communication between all parties. Professionals should always refer to the specific policy wording and relevant clauses, such as the institute clauses for wreck removal, and consider the principles of the Marine Insurance Act 1906. When in doubt, seeking clarification from the insurer or legal counsel specializing in marine insurance is paramount. The focus should always be on a balanced approach that respects the contractual obligations of both parties, while ensuring that losses are mitigated and covered appropriately. Question 14. The investigation demonstrates that a cargo of electronics was damaged during transit due to alleged rough handling by the carrier. The cargo owner, your client, is demanding immediate full settlement of the claim, providing a preliminary report from their own surveyor that attributes the damage solely to the carrier's negligence. However, the vessel's logbook, which you have obtained, indicates unusually severe weather conditions during the voyage, which were not mentioned in your client's initial claim submission. Your client is pressuring you to expedite the claim based on their surveyor's report, suggesting that mentioning the weather might complicate matters and delay payment. What is the most professionally responsible course of action? Option A. Inform the client that you will proceed with the claim as presented, but advise them that the insurer may independently investigate the weather conditions and that any discrepancies could affect the payout. Option B. Advise the client that while the carrier's handling is a factor, the severe weather conditions noted in the vessel's logbook must also be thoroughly investigated as a potential contributing cause to the damage, and that full disclosure of all relevant information to the insurer is a contractual and ethical requirement. Option C. Proceed with the claim based solely on the client's surveyor's report, focusing on the carrier's alleged negligence, and downplay the significance of the weather information to expedite settlement for your client. Option D. Recommend that the client amend their surveyor's report to include the possibility of weather as a contributing factor, even if it means delaying the claim submission. The correct answer is B. Advise the client that, while the carrier's handling is a factor, the severe weather conditions noted in the vessel's logbook must also be thoroughly investigated as a potential contributing cause to the damage, and that full disclosure of all relevant information to the insurer is a contractual and ethical requirement. Explanation. This scenario presents a professional challenge because it requires the marine insurance professional to balance the immediate financial interests of their client, the cargo owner, with their duty to uphold the integrity of the insurance contract and the principles of subrogation. The temptation to overlook minor discrepancies to expedite a claim payout is significant, especially when faced with a distressed client. However, a professional marine insurance practitioner must adhere strictly to the terms of the policy and the governing regulatory framework, which in the context of the Certified Marine Insurance Professional (CMIP) designation implies adherence to the principles of good faith, utmost good faith, and the legal doctrines that underpin marine insurance, such as the Institute cargo clauses and relevant maritime law principles. The correct approach involves a thorough and objective assessment of the evidence presented, comparing it against the policy terms and conditions. This includes verifying the cause of loss, the extent of damage, and ensuring that the claim is not invalidated by any breaches of warranty or misrepresentation by the assured. The professional must act with integrity, providing clear and reasoned advice to the client, even if that advice is not what the client wishes to hear. This aligns with the ethical obligations of an insurance professional to act honestly and competently, and to avoid misleading or deceiving the assured. Specifically, the professional must consider whether the presented evidence supports a valid claim under the policy, or if there are grounds for denial or reduction based on the policy's exclusions or the assured's conduct. The principle of utmost good faith, uberrimi fidei, is paramount, requiring full disclosure of all material facts by both parties. An incorrect approach would be to prioritize the client's immediate satisfaction over contractual obligations and regulatory compliance. For instance, accepting the cargo owner's narrative without independent verification of the loss, or downplaying the significance of the surveyor's findings to facilitate a quicker payout, would be a failure. This breaches the duty of good faith owed to the insurer and undermines the principle of indemnity, as the insurer is only obligated to compensate for losses covered by the policy. Furthermore, failing to properly investigate the cause of loss and potentially paying a claim that is not valid could lead to financial losses for the insurer and set a dangerous precedent. Another incorrect approach would be to advise the client to withhold information from the insurer, which is a direct violation of the duty of disclosure and could lead to the claim being invalidated and potential legal repercussions. The professional decision-making process in such situations should involve a systematic review of the policy wording, the facts presented, and any expert reports. The professional should clearly articulate the policy provisions relevant to the claim, the findings of the investigation, and the potential implications of those findings for the claim's validity. If there are ambiguities, they should be resolved in accordance with established legal principles and industry practice. The professional must maintain objectivity, communicate transparently with all parties involved, client and insurer, and provide advice that is both legally sound and ethically responsible. Question 15. During the evaluation of a marine insurance claim for a vessel that has sustained significant damage, what is the most appropriate approach for an underwriter to determine if the loss constitutes a constructive total loss, CTL, under the Marine Insurance Act 1906, considering the vessel's insured value? Option A. Calculate the total cost of salvage, repair, and redelivery, and compare this sum to the vessel's market value immediately prior to the casualty. A CTL is declared if these costs exceed the pre-casualty value. Option B. Assess the extent of visible damage, and if it appears substantial, consider the assured's opinion on the likelihood of a CTL to expedite the claim settlement process. Option C. Declare a CTL if the cost of repairs is estimated to be more than 75% of the insured value, as this is a common industry benchmark for significant damage. Option D. Include potential future earnings and consequential business losses in the calculation of repair costs to determine if the overall financial impact justifies a CTL declaration. The correct answer is C. Declare a CTL if the cost of repairs is estimated to be more than 75% of the insured value, as this is a common industry benchmark for significant damage. Explanation. This scenario is professionally challenging because determining a constructive total loss, CTL, involves a complex interplay of physical damage, repair costs, and the vessel's market value, all within the strict confines of the Marine Insurance Act 1906, MIA 1906, and relevant case law, which are the governing principles for this CMIP exam. The underwriter must exercise significant judgment to ascertain if the cost of recovering and repairing the vessel would exceed its insured value, a decision with substantial financial implications for both the insurer and the assured. The correct approach involves a meticulous assessment of all relevant costs and values, strictly adhering to the principles laid out in Section 60 of the MIA 1906. This section defines a CTL as occurring when the assured is deprived of the vessel, or when the cost of recovering, repairing, and redelivering the vessel would exceed its value when so recovered, repaired, and redelivered. This requires the underwriter to obtain accurate estimates for salvage, repair, and survey fees, and to determine the vessel's market value immediately prior to the casualty. The decision must be based on objective evidence and a sound interpretation of the law, ensuring that the claim is handled fairly and in accordance with the policy terms and statutory requirements. An incorrect approach would be to declare a CTL based solely on the extent of visible damage without a thorough cost-benefit analysis. This fails to meet the statutory threshold of the cost of repair exceeding the insured value. Another incorrect approach would be to include speculative or ancillary costs not directly related to recovery and repair, such as potential loss of earnings or consequential business losses, as these are typically not recoverable under a CTL declaration under the MIA 1906. Furthermore, making a decision based on expediency or pressure from the assured, without due diligence and adherence to the legal framework, constitutes a failure to act professionally and ethically, potentially leading to an unfounded claim payment or a wrongful rejection of a valid claim. Professionals should approach such situations by first establishing the factual circumstances of the casualty. They must then gather all necessary documentation, including survey reports, repair estimates, and evidence of the vessel's pre-casualty market value. The next step is to apply the legal tests for CTL as defined by the MIA 1906, meticulously comparing the estimated costs against the insured value. This process requires an objective and impartial evaluation, free from external pressures, and a clear understanding of the legal precedents. If the criteria for CTL are met, the underwriter should proceed with the declaration, ensuring all policy conditions and statutory requirements are satisfied. If not, the claim should be treated as a partial loss. Question 16. Market research demonstrates a significant increase in the adoption of novel, hybrid electric propulsion systems on a specific class of offshore support vessels. A potential client, operating a fleet of these vessels, is seeking hull and machinery insurance. The insurer's underwriting team is concerned about the potential for unique machinery breakdown claims and the interaction of these systems with traditional marine perils. What is the most appropriate approach for the marine insurance professional to take when advising this client and underwriting this risk? Option A. Advise the client to obtain a comprehensive independent technical survey of the hybrid electric propulsion system, review manufacturer specifications and warranties, and then work collaboratively with the insurer's technical and claims departments to tailor policy terms, including potential endorsements or specific conditions, to accurately reflect the identified risks and ensure adequate coverage. Option B. Assume that existing H&M machinery breakdown clauses will adequately cover any issues arising from the hybrid electric propulsion system, as these systems are essentially variations of conventional engines. Option C. Recommend standard H&M policy wordings with a broad exclusion for all new technology propulsion systems to mitigate unknown risks. Option D. Rely solely on the vessel owner's representations regarding the reliability and maintenance of the hybrid electric propulsion system, without further independent investigation or consultation with technical experts. The correct answer is C. Recommend standard H&M policy wordings with a broad exclusion for all new technology propulsion systems to mitigate unknown risks. Explanation. This scenario presents a professional challenge because it requires the marine insurance professional to navigate the complexities of hull and machinery, H&M, insurance coverage in the context of evolving vessel technology, and the potential for novel claims. The challenge lies in accurately assessing and advising on coverage for a new type of propulsion system, which may not be explicitly addressed in standard policy wordings or established claims precedents. Careful judgment is required to balance the insurer's need for clear risk assessment and premium adequacy with the insured's expectation of comprehensive protection for their investment. Correct approach involves a thorough review of the vessel's specifications, the operational parameters of the new propulsion system, and a detailed analysis of how this technology might interact with potential marine perils. This would include consulting with technical experts, reviewing any manufacturer warranties or performance guarantees, and assessing the system's susceptibility to damage from common H&M risks such as grounding, collision, fire, or machinery breakdown. The professional must then determine if existing policy clauses adequately cover these risks, or if endorsements or specific exclusions are necessary. This approach aligns with the professional duty to provide accurate and informed advice, ensuring that the policy accurately reflects the risks being insured, and that the insured understands the scope of their coverage. It upholds the principles of utmost good faith by ensuring transparency and a clear understanding of the contract between insurer and insured, and adheres to regulatory expectations for prudent underwriting and risk assessment. An incorrect approach would be to assume that standard H&M clauses automatically cover the new propulsion system without specific investigation. This fails to acknowledge that technological advancements can introduce new or altered risks that may not be contemplated by older policy wordings. This could lead to underpricing of the risk, potential for unexpected claims, and ultimately, financial losses for the insurer. It also breaches the duty of care owed to the insured by failing to ensure they have appropriate coverage for their specific vessel and its unique features, potentially leaving them uninsured for a significant portion of their investment. Another incorrect approach would be to automatically apply a broad exclusion for new technology without a detailed risk assessment. While exclusions are a valid tool for managing uninsurable or poorly understood risks, a blanket exclusion without due diligence is unprofessional and potentially unfair to the insured. It fails to explore whether the risks associated with the new technology are, in fact, insurable with appropriate pricing and conditions. This approach demonstrates a lack of proactive risk management and a failure to adapt to industry innovation, potentially alienating clients and missing opportunities for well-underwritten business. A further incorrect approach would be to rely solely on the vessel owner's assurances about the system's reliability without independent verification. While the owner has a duty of disclosure, the marine insurance professional has a responsibility to conduct their own due diligence to assess the risk objectively. This reliance on potentially biased information could lead to an inaccurate assessment of the risk, resulting in inadequate premiums or coverage gaps. It undermines the principle of prudent underwriting and the professional's obligation to act in the best interests of both the insurer and the insured by ensuring a fair and accurate reflection of the risk in the policy. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with a comprehensive understanding of the insured asset and its operational context. It then requires identifying potential perils and their likelihood and severity, particularly in light of any novel features. Consulting with technical experts and reviewing all relevant documentation is crucial. Based on this assessment, the professional must determine the appropriate coverage, including any necessary endorsements, exclusions, or special conditions, ensuring that the policy accurately reflects the risk and that all parties have a clear understanding of the terms. This process ensures compliance with regulatory requirements for sound underwriting and upholds ethical obligations to act with diligence and integrity. Question 17. The performance metrics show a significant increase in claims related to spoilage for frozen food shipments. Considering the Certified Marine Insurance Professional (CMIP) regulatory framework and common clauses related to specific commodities, which of the following actions best demonstrates a professional and compliant approach to addressing this trend? Option A. Conduct a detailed review of the specific policy clauses and warranties applicable to frozen food shipments, including temperature control requirements and transit conditions, to determine if claims are a result of covered perils or breaches of warranty, and assess the adequacy of existing coverage. Option B. Assume that all spoilage claims for frozen food are automatically covered under the Institute cargo clauses, A, and process them accordingly, without investigating the specific circumstances or potential exclusions. Option C. Immediately implement a blanket increase in premiums for all frozen food cargo policies to offset the rising claims, without a granular analysis of the causes of spoilage or individual policy terms. Option D. Rely solely on the historical claims data to justify a general increase in rates for frozen food insurance, disregarding the specific policy wording and the insured's adherence to risk management protocols. The correct answer is A. Conduct a detailed review of the specific policy clauses and warranties applicable to frozen food shipments, including temperature control requirements and transit conditions, to determine if claims are a result of covered perils or breaches of warranty, and assess the adequacy of existing coverage. Explanation. The performance metrics show a significant increase in claims related to spoilage for frozen food shipments. This scenario is professionally challenging because it requires a deep understanding of how specific commodity clauses in marine insurance policies interact with the inherent risks of transporting perishable goods. The underwriter must not only assess the financial impact of these claims, but also critically evaluate the adequacy and application of the policy wording to prevent future losses. This involves a nuanced interpretation of clauses like the Institute cargo clauses, IC, and any specific endorsements or warranties related to temperature control, handling, and transit times for frozen goods. The correct approach involves a thorough review of the specific clauses applicable to frozen food shipments within the policy. This includes examining any warranties regarding temperature maintenance, the adequacy of refrigeration equipment, and the insured's adherence to stipulated transit procedures. The underwriter must then assess whether the claims are a direct result of a breach of these warranties, or if the policy's coverage, as defined by clauses like ICC A, B, or C, and any specific endorsements, is indeed triggered by the circumstances of the spoilage. This approach is correct because it directly addresses the contractual obligations and risk management expectations outlined in the policy, aligning with the principles of utmost good faith and the insurer's duty to underwrite risks accurately. It also adheres to the regulatory expectation that insurers will apply policy terms and conditions fairly and consistently. An incorrect approach would be to simply increase premiums across the board for all frozen food shipments without a detailed analysis of the underlying causes of spoilage and the specific policy terms. This fails to identify whether the losses are due to inherent risks not adequately covered, breaches of warranty by the insured, or inadequate policy wording. It also risks penalizing insureds who have robust risk management practices. This approach is professionally unacceptable as it deviates from the principle of underwriting based on specific risk assessment and may violate regulatory requirements for fair pricing and risk-based premium adjustments. Another incorrect approach would be to assume that all spoilage claims are automatically covered under a broad all risks clause, without scrutinizing the specific conditions and exclusions that might apply to perishable goods. For instance, certain clauses may exclude spoilage arising from gradual deterioration or inherent vice, unless directly caused by a covered peril. Failing to investigate these nuances and apply the policy terms precisely can lead to incorrect claim settlements and mispriced future business. This is ethically problematic as it can result in either underpayment of valid claims or overpayment of invalid ones, undermining the integrity of the insurance contract and potentially breaching regulatory guidelines on claims handling. A third incorrect approach would be to rely solely on historical claims data without correlating it to the specific policy clauses and the insured's adherence to them. While performance metrics are valuable, they must be interpreted within the context of the contractual agreements, ignoring the specific wording of clauses related to temperature control, transit duration, or packaging for frozen goods, and instead making broad assumptions based on past loss ratios is a failure of due diligence. This can lead to misinterpretation of risk and potentially inadequate coverage or excessive premiums, which is contrary to the professional duty of accurate risk assessment and policy application. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the performance metrics and identify the specific type of loss. Second, meticulously review the relevant policy clauses, including any endorsements, warranties, or exclusions pertaining to the commodity in question. Third, investigate the circumstances of the loss to determine if it falls within the scope of coverage and if any policy conditions have been breached. Fourth, consult with claims adjusters and technical experts if necessary. Finally, based on this comprehensive analysis, make an informed decision regarding claim settlement, premium adjustments, or policy wording revisions, ensuring compliance with all applicable regulations and ethical standards. Question 18. Comparative studies suggest that clients often seek the most cost-effective insurance solutions. A client involved in the international shipment of high-value electronics, a cargo known for its susceptibility to damage from water, theft, and accidental breakage during transit, has requested the most basic level of coverage available under the Institute cargo clauses, citing budget constraints. As a certified marine insurance professional, what is the most ethically and professionally sound approach to advising this client? Option A. Provide a brief, general overview of the Institute cargo clauses without delving into specific risks covered or excluded, and then allow the client to select the clause they believe is most suitable. Option B. Recommend Institute cargo clauses. A. As it provides the broadest coverage, ensuring the client is protected against all risks, regardless of the premium cost. Option C. Explain in detail the scope of coverage, exclusions, and conditions of Institute cargo clauses A, B, and C, highlighting how each clause addresses different risk profiles, and then recommend the clause that best matches the specific risks associated with high-value electronics and their transit, even if it means a higher premium, ensuring the client understands the implications of their choice. Option D. Advise the client that Institute cargo clauses, C, is the most cost-effective option and proceed with that coverage, as requested, to meet their budget requirements. Correct answer is C. Explain in detail the scope of coverage, exclusions, and conditions of Institute cargo clauses A, B, and C, highlighting how each clause addresses different risk profiles, and then recommend the clause that best matches the specific risks associated with high-value electronics and their transit, even if it means a higher premium, ensuring the client understands the implications of their choice. Explanation. This scenario presents a professional challenge because it requires the marine insurance professional to balance the insured's desire for broad coverage with the insurer's need for clear and defined risk parameters, all within the confines of the Institute cargo clauses IC. The ethical dilemma arises when a client, seeking to minimize perceived costs, requests a policy that may not adequately reflect the actual risks of their cargo, potentially leading to underinsurance and future disputes. A professional's duty is to advise accurately and ethically, ensuring the client understands the implications of their choices, rather than simply fulfilling a request that could be detrimental. The correct approach involves clearly explaining the differences between Institute cargo clauses A, B, and C to the client, highlighting the scope of coverage and the types of risks each clause addresses. This includes detailing the exclusions and conditions applicable to each. The professional must then recommend the clause that best aligns with the specific nature of the cargo, its transit, and the associated perils, even if it means a higher premium. This aligns with the ethical duty of care and the professional obligation to provide sound advice, ensuring the client is adequately protected and understands the policy they are purchasing. Regulatory frameworks in marine insurance emphasize transparency and the provision of accurate information to policyholders. An incorrect approach would be to accede to the client's request for the cheapest option, institute cargo clauses C, without a thorough risk assessment and clear explanation of its limitations. This fails to uphold the duty of care, as it knowingly allows the client to purchase a policy that is likely insufficient for their needs, potentially leading to significant uninsured losses. Ethically, this is a dereliction of duty, as it prioritizes short-term client satisfaction over long-term client protection and financial well-being. It also breaches the principle of utmost good faith, as the professional is not acting in the client's best interest by facilitating a potentially inadequate insurance solution. Another incorrect approach would be to automatically recommend institute cargo clauses, A, without considering the client's specific circumstances and risk appetite. While A offers the broadest coverage, it may be unnecessarily expensive for certain low-risk cargoes or transit routes. This approach, while seemingly client-centric by offering maximum coverage, could be seen as pushing unnecessary coverage, potentially violating the principle of proportionality and failing to provide tailored advice. The professional's role is to find the appropriate level of coverage, not necessarily the highest. A third incorrect approach would be to provide a vague overview of the clauses without detailing the specific risks covered and excluded by each. This lack of specificity prevents the client from making an informed decision. It fails to meet the regulatory requirement for clear and understandable policy information, and breaches the ethical obligation to ensure the client comprehends the terms of their insurance contract. The professional decision-making process for similar situations should involve a structured risk assessment of the cargo and transit, followed by a clear, detailed explanation of the available coverage options, like A, B, C, and their respective implications. This explanation must be tailored to the client's understanding and address their specific concerns. The professional should then provide a recommendation based on the risk assessment, clearly articulating the rationale behind it, and allow the client to make the final, informed decision. Transparency, accuracy, and a commitment to the client's best interests are paramount. Question 19. The monitoring system demonstrates that a vessel, insured under two separate marine hull policies with different underwriters, has sustained damage during a voyage. Both policies were active at the time of the incident and cover the same insured peril. The insured has submitted a claim for the full amount of the damage to one of the underwriters. What is the most appropriate professional course of action for the underwriter receiving the claim? Option A. Reject the claim outright, stating that the existence of multiple policies constitutes double insurance and invalidates the claim. Option B. Advise the insured that they must first seek settlement from the other underwriter before any payment can be made. Option C. Settle the claim based on the proportion of the sum insured under their policy relative to the total sum insured across both policies, and then inform the other underwriter of their liability for the remaining proportion. Option D. Settle the claim in full with the insured, then seek recovery from the other underwriter based on the principle of contribution. The correct answer is D. Settle the claim in full with the insured, then seek recovery from the other underwriter based on the principle of contribution. Explanation. This scenario presents a professional challenge because it involves the principle of contribution, a fundamental aspect of marine insurance where multiple insurers share a loss proportionally. The complexity arises when there is potential for double insurance, meaning the same risk is insured by more than one policy. Navigating this requires a thorough understanding of the relevant regulatory framework to ensure fair treatment of the insured and adherence to legal obligations. The professional's judgment must be guided by the specific provisions governing contribution and double insurance to avoid disputes and maintain market integrity. The correct approach involves recognizing that the insured has a right to be indemnified for their loss. When multiple policies cover the same risk, the insurers are obligated to contribute to the settlement of the claim based on the principle of contribution. This principle dictates that each insurer pays a proportion of the loss corresponding to the sum insured by each policy relative to the total sum insured across all policies. This ensures the insured is not overcompensated, and that the burden of the loss is shared equitably among the insurers, as mandated by the principles of indemnity and good faith inherent in marine insurance law and practice. An incorrect approach would be to deny coverage based on the existence of multiple policies, arguing that the insured has already been compensated, or that the insurers should sort out the liability amongst themselves without immediate action. This fails to acknowledge the insured's right to indemnity and the insurer's collective responsibility. Another incorrect approach would be to arbitrarily assign liability to one insurer without considering the contribution principle, potentially leading to an unfair distribution of the loss and violating the contractual obligations of the other insurers. Further incorrect approach would be to delay the settlement process significantly while attempting to resolve the contribution issue internally, thereby failing to act with reasonable promptness and potentially causing financial hardship to the insured. Professional decision-making in such situations requires a systematic process. First, identify the existence of multiple policies covering the same risk. Second, determine if the policies are in force and cover the specific loss. Third, apply the principle of contribution to ascertain each insurer's proportionate liability. Fourth, communicate clearly with all involved insurers and the insured regarding the process and expected settlement. This methodical approach, grounded in regulatory compliance and ethical practice, ensures a fair and efficient resolution. Question 20. Investigation of the process by which a P&I Club's Joint Hull Committee determines the appropriate level of an additional call to be levied on its members for the upcoming policy year, considering the club's recent claims experience and projected future liabilities, requires adherence to specific governing principles. Which of the following best reflects the mandatory considerations for this determination under the relevant regulatory framework and the club's own rules? Option A. The committee can set the call based on market trends in other insurance sectors, aiming to align with general industry pricing strategies. Option B. The committee must assess the club's current financial position, including its reserves, investment performance, and projected claims, and calculate the call in strict accordance with the P&I Club's Articles of Association and the applicable regulatory requirements for mutual insurers. Option C. The committee may adjust the call based on individual member feedback regarding their perceived risk exposure, irrespective of the club's overall financial needs. Option D. The committee should primarily consider the average call levels from the previous 5 years to ensure consistency and predictability for the membership. The correct answer is B. The committee must assess the club's current financial position, including its reserves, investment performance, and projected claims, and calculate the call in strict accordance with the P&I Club's Articles of Association and the applicable regulatory requirements for mutual insurers. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the marine insurance professional to navigate the complexities of premium assessment within the context of a fluctuating risk profile, specifically related to the call system of a protection and indemnity P&I Club. The core challenge lies in accurately reflecting the evolving risk and financial needs of the club membership in the calls levied, ensuring fairness to all members while maintaining the club's solvency. This demands a deep understanding of the P&I Club's rules, the principles of mutual insurance, and the regulatory expectations governing such entities. Correct approach analysis. The correct approach involves a thorough review of the P&I Club's financial performance, including claims history, investment returns, and projected future liabilities, in conjunction with the club's governing rules and the relevant regulatory framework. This approach is right because it directly addresses the principles of mutual insurance, where members contribute to a common fund to cover shared risks. The P&I Club's rules, which are legally binding on members, dictate the methodology for assessing calls. Regulatory oversight, such as that provided by the Prudential Regulation Authority, PRA in the UK, ensures that the club maintains adequate reserves and operates prudently. A call must be calculated in accordance with these rules and regulatory requirements, reflecting the club's financial position and the members' proportionate share of the risk. This ensures fairness and solvency. Incorrect approach is analysis. An approach that focuses solely on historical premium levels without considering current financial performance or future projections is incorrect. This fails to adapt to changing risk environments and the club's financial needs, potentially leading to underfunding or overcharging members, which violates the principles of mutual insurance and could breach regulatory solvency requirements. An approach that prioritizes maintaining a stable call amount for members regardless of the club's financial health is also incorrect. While member stability is desirable, it cannot come at the expense of the club's ability to meet its obligations. This disregard for financial reality can lead to a deficit, requiring supplementary calls, or jeopardizing the club's solvency, a clear breach of regulatory duty. An approach that deviates from the P&I Club's established rules for call assessment without proper authorization or justification is fundamentally flawed. The rules provide the legal and operational framework for the club. Any deviation without adherence to the prescribed amendment procedures or regulatory approval undermines the contractual obligations between members and the club, and likely contravenes regulatory mandates for transparent and rule-based operations. Professional reasoning. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the governing P&I Club rules and the applicable regulatory framework, e.g., the PRA's Solvency Roman II requirements for insurers if applicable to the club's structure. This involves analyzing the club's financial statements, claims data, and forward-looking risk assessments. The next step is to determine the call amount by applying the methodology stipulated in the club's rules, ensuring that the call is proportionate to each member's share of the risk and the club's overall financial requirements. This process must be transparent and justifiable, with clear documentation supporting the assessment. Regular review and adaptation based on evolving financial and risk landscapes are crucial, always within the bounds of the rules and regulations.